When it comes to investing, a lot of people love the dividend yields of dividend investing, but not choosing individual stocks. When it comes to stocks and investing in them specifically, it is very hard to determine what individual stocks are going to do incredibly well, which ones are going to struggle. This is where the ETFs come in. Now, for me, SCHD is a no-brainer when it comes to the ETF. And I want to break it down because me personally, I have almost 35% of my portfolio in the SCHD. Now, a lot of people might wonder why I don't have more, why I kind of diversify the portfolio. The reason being, even though it offers a very strong growth and a very good dividend yield, it does not make, and really, in my opinion, cannot make up an entire portfolio. And I want to break down exactly why. Now, when we start thinking about the SCHD, it has a growth rate of roughly 12% per year, which is kind of crazy since its inception. Now, that means every 6 years it is doubling in size. Now, traditionally, rule of seven says every 7 years it is going to double the portfolio, where this specific ETF has done it in 6. Now, of course, looking at the growth, we can see some good years, some bad years, but overall, the performance within this one is pretty consistent. It relies on a lot of blue chip companies that are offering a pretty good return. And that is the reason why it's very attractive, is not only the growth that we've seen out of the portfolio itself, which we're going to look at, but also the dividend growth that we're seeing. So it was a little bit of dividend per share was pretty good. But now since then, we've seen a lot of movement with the SCHD, including a 3-to-1 split back in, I believe, October. And now, of course, the price is a very, very good buy. When you start looking at the consistently and the growth in here, thinking of some S&P funds like the SPY or the VOO, it has been doing incredibly well. But even looking at the SCHD over the last 10-year period, now thinking about this, it's grown by 318%, which the VOO would have grown by 290%. So you are edging it out a little with the SCHD versus the VOO. That is because of the market stability that we see with the VOO and being into every single sector. Now, of course, it is a very low cost. This is something that is really primed when it comes to ETFs. They do have a very low cost. And when we start looking at a 0.06 expense ratio, meaning you're paying 6 cents on the dollar, which is current, or six cents per thousand, which again is kind of crazy for a very, very low expense ratio. And of course, this has changed every single year, not the expense ratio, but the holding of the SCHD itself changes every single year. Now, when we start looking at some of like the SDY has an expense ratio of 0.35, which is $35 on every 10,000 invested, which means you're getting a much better return because the fee is not there. Now, the other part with the SCHD is the low volatility. When you start looking at the VGT, the QQQ, which I actually do hold both of them, the volatility for the SCHD has very low volatility, and of course is really a lot better when it comes to stability if you're looking to add in the portfolio. Not only the great yield, when we start thinking of the yield, 3.43, which I believe it's even higher now, which is kind of crazy. So even looking at the VYM, some of the Vanguard ETFs, they are underperforming where the SCHD is. And then, of course, looking at some of those like Coca-Cola and Pepsi that are paying less than a 3% yield is really making a big difference. So let's hop over and really break this down and show you exactly what it looks like when you're putting money into the SCHD and how this kind of breaks down. So looking at Schwab US Dividend Equity ETF, again, a 0.06 summary of this, definitely looking to do the total return of the Dow Jones US Dividend 100. Very straightforward, very low cost, like we talked about. Absolutely worth it. Now, looking at the fund detail, you can see $27 a share. Now, this, like I said, last year did that 3-to-1 split, which I believe it was October, which was correct, did a 3-to-1 share, making this fund a lot more affordable. And you can see when you start breaking this down mathematically, it does make sense. Return on equity, 27%. So pretty good there. Price to earning ratios, 18. So still pretty much on the lower end. Total expense ratio, that 0.06. Very good there. Now, the total holdings, 102 companies. This is something to note. With 102 companies that it's invested in, we are not seeing the full 500 that we see with that S&P 500. And of course, like I said, this does a rebalance every single year. And looking at the yield right here, SEC yield, 30-day yield 3.75, even distribution 3.63. So it is doing exactly what it needs to be with the yield. The yield is good. And I believe, again, The S&P 500 is around 1.7. So thinking almost 3.7 here, definitely pretty good. Now, month-to-month basis, this is where it gets pretty interesting when you start factoring the growth factor that we see with the SCHD. And I want to show you exactly how I'm using this to take money and essentially create more money with the SCHD. I love how it works. So like I've said, cumulative, the 1 month and the 3 month, you can see both of those are negative, but looking at the Dow Jones US Dividend 100, again, negative. So they're kind of right on par, as you can see, to what it likes to track. Large value, the Morningstar category, again, negative. Year to date, now this is year to date, and I didn't see anything in here saying the date from the year to date. So I'm assuming this is probably from not this year that we're seeing this much growth for the year to date in January. I'm assuming this is for 2024 in the entirety. When we look at year to date, most of these did break it out that way. So year to date, around 11%, again, tracking that Dow Jones US Dividend 100, right on par with it. But this is where it gets interesting, because when you start looking at the dividend growth that we have in here, we're going to look at the dividend calculator in just a minute. But when you look at the 3-year, you can see we're running around 4%. Last 2 years have done incredibly well for the S&P 500 due to artificial intelligence, quantum computing. A lot of very, very high tech companies have driven to those double-digit gains that we've seen. But looking at the 5-year, we're at 11%, 10 years still at 11%, so almost outperforming even the large value. Then since inception, we are at 13%. So if you essentially got in here 10/20 of 21, or excuse me, 2011, so looking at the last, 14 years now, you would have gotten about 13%, which is kind of crazy when you look at the annualized returns in here, including it generates a lot of income. So with the income or the dividend generation, that is what goes back into my investment portfolio. And when you have the drip, so when you do the dividend reinvestment, it does make a very big difference when you look at exactly what it looks like overall. Again, since inception, even after taxes, you're looking at a pretty good rate of about 10%, almost 11% in there, which is really strong. Now, when we get into actually investing, SCHD dividend calculator, this is where it gets very interesting. So me personally, I want to use my numbers, and I always want to use my numbers. So right now we're at about 30,000 that is invested in there. So looking at calculating now, of course, extra investment amount we're keeping at nothing, because I want to see just what this one is going to be doing. So when you start looking at annual income, and this is the point where supplementing something like the SCHD could replace a big chunk of your Social Security income. And that is exactly my plan. So looking here, we have year one, you can see $1,151. When you think about that, you're making about $100 a month. So when I kind of break it down, that could cover my internet bill, that could cover my phone bill. What exactly is it going to look like to the point where I can flip on this SCHD switch and essentially start earning money from the SCHD that is coming as dividends? Now, of course, there is tax liability, but when you start looking at the ability to go probably the next 10 or 15 years with a dividend reinvestment, and you'll notice the difference here, the drip or the dividend reinvestment is going to compound. And that is why you see the big growth over the non-drip, because this is taking the actual income itself. And then when you start looking at this going up, that is the reason of the dividend growth year over year that the SCHD does focus on. So when you start looking even at 10 years from where we are right now, you're going to be looking with reinvestment about $4,000 a year is where we're getting up to. So again, thinking bigger picture at $4,000 a year, even if we invested, which we are investing on a very regular basis, if we could get this up to $5,000, $6,000, $7,000 a year, that is going to cover a lot of costs, especially when you have a mortgage that's paid off, you don't have very many expenses. And that is what I want to do essentially, is get to the point of dividend income that it's covering all of my expenses. Then, of course, when you talk about capital gains tax, not going to have to worry about that because you don't have much earned income if you're not working at that time. But then we start breaking into the total balance. Now, this again is where it gets very, very interesting, because you can see the total balance that you're looking in the portfolio right here is around 113,000. So when you start looking at the stock accumulation, even here, dividends over 10 years, you're talking almost 18,500 accumulated dividends. Not only the increase in the value of the stock, but also the compounding of the dividends through the drip effect. And breaking it down here, you can see This is kind of what they're forecasting for the next 10 years. What exactly it's going to look like. Total investment is still staying at that exact same amount. Now, for making regular contributions, that is going to make a big difference. And then, of course, I feel like this dividend yield is going to stay pretty consistent or is going to go higher because, like we said with the SCHD, they are actually doing a rebalance with this every single year, which I believe it comes up in March, that they are going to go ahead and rebalance this overall. So again, looking at the, adding everything in, you're looking at $113,000 in the next 10 years on a $30,000 investment, which we can see right there, which is kind of crazy when, again, you think of the compounding. So annual dividend per share, they kind of break it down every single quarter, yielding that 3.79. So again, when you start looking at the yield, not only are you combining the dividend yield that you're getting in there, but you are also getting the growth aspect of this. And that is the reason why the SCHD is one of the absolute best ETFs when it comes to dividend and when it comes to dividend equity to invest in general. Me personally, like I said, I have roughly 35% of my portfolio in here. And what I'm doing personally is I am taking every dollar that we are getting from YouTube AdSense. So through the revenue sharing, through the memberships, through all of the super chats, the donations that we're getting to the channel, everything in its entirety and everything, of course, that we're earning from YouTube is going back into the SCHD. It is invested with M1 Finance. I have a link down below if you want to invest there. But overall, we are putting money and it is just continuing. So far, since we've been monetized, we've made about $1,300 in the channel. So that $1,300 went right back into the SCHD, and getting to the point where even then, if you're looking at putting, $200 or $300 every single month in here, again, based on what we're building, you can see dividends are going through the roof. Then, of course, a lot of people say $100,000 is all you need. Now, when we start looking at a bigger, and again, portfolio through a extended amount of time, you have 3,577 shares as it sits today with that 100,000 invested. And looking at the dividends, even the first year, I mean, you're at 3,800. If you're going ahead, letting those investing by 10 years, you're looking at $13,000 a year that you're getting in annual dividends. Now, thinking about that, this is the point where you can start replacing a lot of your monthly income with dividend and really annual dividends, because then again, extrapolate, you think about this compounding over a couple of years, even looking at the growth factor right here, you're almost up to $400,000 when it comes to this. So having it in a portfolio, having it grow at that $100,000 balance, you can see right here, we're almost, $380,000, but you're looking at $13,000 every single year. That doesn't include, again, if dividend yield changes, if the value of this goes a lot higher, you're looking at 13. Now imagine getting this up to 20, 25, 30,000. So you got 200,000 invested into the SCHD. You could technically replace your income in its entirety with the dividend calculation that we have here. So my thought is, with the larger portfolio, $500,000 portfolio, even getting to that level, is at what point can I take a portfolio, move it into something like the SCHD, be able to supplement my income, and right here would be $65,000 a year after 10 years that you're getting out of this. But again, supplementing your income in its entirety with a $500,000 portfolio, and then going in there, and this is going to be your income. Because again, when you start looking even here at the beginning, you're talking 20 grand a year for doing nothing. Absolutely nothing, because you're just getting the dividends, keeping those dividends, and making $20,000 a year. So the more that you have invested, of course, the more you're going to grow. Now, me personally, when it comes to investing into something like the SCHD, I use my now 4 ETF portfolio. So 30% in that SCHD, we have 30% in the VOO, which of course is my foundational. It's growing incredibly well. We have 35% to equal 95% into the QQQM. That, of course, is the very big stock player. So as it's growing faster within the technology ETF and it's growing within the S&P 500 ETF, there's going to be a point where I just sell out of my positions in there, put a majority of it into the SCHD, and live off the dividends for the rest of my life without ever having to touch and really get to that initial principal. Now, the last 5% of that portfolio is, of course, invested in Bitcoin BTC. It is really something that I feel like most people should have a little bit of exposure to. If Bitcoin goes to, $200,000, $300,000, $400,000 over the next 10, 20, 30 years. It's going to be kind of incredible because we're buying it, dollar cost averaging into it right now. Then, of course, dividends we get from the QQQM, from the VOO, from the SCHD are all just compounding back into the portfolio through, again, dollar cost averaging when they're paid every quarter, investing in really the drip and putting them right back into the portfolio itself. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.